you have to build insurance products the same way you build a bridge, such that it can't fail.
Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. How are you?
Man, I'm doing really good. I'm blown away on how well that interview went. When we first talked about this topic of interviewing insurance companies and asking them some questions, first I'm like, this is important, but it may not be one of our most exciting podcasts, but it still may not be one of the most exciting ones. Okay. But there's some great information here. And I think that this is very important to learn, because if we're putting our money in with an insurance company, it's important to know about the company and how they work. And also, when we first requested an interview, I didn't know what to expect on who it was going to be. But with the president of One America taking the time to meet with us and with you, I think that just showed the value of working with these mutual companies and how much that they appreciate their advisors, but more importantly, they appreciate the policyholders.
I agree 100%. We just finished up the interview with Dennis Martin. He was the president of Life and Financial Services for One America. And also we had Steve Cox, which is the president of product development. And these guys shared some really good nuggets. I agree. I thought it was going to be a total snoozer when we were talking about interviewing these guys, but it was excellent. And man, if you don't mind, I'm going to jump right into some of my takeaways. Again, I think Anthony mentioned this. There's a couple companies that we use, right? Not every company is a one size fits all. And so AUL is a perfect example. We have some criteria I look for when I'm working with the client, in which I'll recommend AUL. And typically, a lot of business owners I'll recommend, a lot of entrepreneurs I'll recommend that we go with AUL. Some of the reasons being that they are a non-direct recognition company. And so what they're going to do is they're going to tell us exactly what that means and some of the benefits of that. Great explanation in there. They have very flexible PUAs, which means that as business owners our bank accounts don't always match up with premiums. Right. So flexibility on PUAs and how we can pay those premiums and when, it's excellent. And then also they have the option of paying in very large lump sums in that first year. So those are kind of the criteria I look for when I do recommend AUL with clients. But there was a couple things that these guys said, and there was one quote in there, and he said that we were talking about financial stability. I mean, we are in times of uncertainty and looking out into the future and trying to predict what happens. What's the point, right? So we've got to get ourselves in a position for the unexpected. But I love one of the things that I forget who said it, but they said that they are in a position, or one of their company's mottos is to deliver on promises when clients need us the most. And so the example that he gave us was them paying out dividends in the early I forget, in the 2000s, right, in the bubble, right, in the 80s when interest rates were super high, in the 2000s when there was an internet bubble, and then also again in 2008, 2009 through the Great Recession. Very consistent. And they also, I forget the numbers that they've said, but they're in a position to grow in a very tough environment. They've had continued growth over the last 10 to 15 years, which I thought was a testament just to some of their business models and the practices they put in place. Great information.
Yeah, I first started working with, as you guys know my story, I got into this teaching IBC after the latest financial crisis. And I went to, when I went to their home office, when other companies, including the government, was getting downgraded by these rating agencies, One America actually got increased during one of the worst times we've seen in a long time. And some of the takeaways that I had is how they explain dividends. Really, what is a dividend and how is it calculated? But also this question I've been getting a lot is, in this low interest rate environment, how is the insurance company going to handle this if this continues? And I thought they did a really good job explaining that on how they're going to be, how they're setting themselves up for a potential of a long-term interest rate environment.
Excellent. We got some really good information, and I know you guys are going to enjoy it.
Enjoy this episode.
Welcome to the Infinite Wealth Podcast. This is Cameron Christensen, along with our co-host, Anthony Faso. Anthony, welcome.
Well, thank you. Looking forward to us diving a little bit deeper into insurance companies and dividends and how they work.
Absolutely. This is going to be a great topic for us. This is one of the questions that we get. I don't know about you, Anthony, but I get that typically on a daily basis we're talking about dividends. And so today we've got Dennis Martin and Steve Cox joining us. And welcome, gentlemen. How are you?
Doing good, thank you. This is Dennis.
Yep, and this is Steve. Doing well. Looking forward to it.
Well, thank you, guys. If you guys could, before we get started, will you guys maybe take a minute or two and give us a little bit about your background and your titles that you guys hold, please?
Sure, I'll start. This is Dennis Martin. I'm currently president of the Individual Life and Financial Services division of One America. I've been with the company for 10 years. Prior to that, worked at another insurance company in the U.S. and originally started my career in Canada, where I worked for 9 years. Actuary by background, and in my current role, responsible for the life annuity and long-term care products, the manufacturing operations, and the distribution of those products for One America.
Wow.
And I'm Steve Cox. I'm Steve Cox. I'm the Vice President of Product Development. I work for Dennis here in the Individual Life and Financial Services division at One America. I've been running the pricing product development team for the last 7 years. I've been at One America for 31 years in a variety of different positions, and currently have been working on a lot of our 17 CSO products as we enter into 2020 with a new portfolio.
Great. Well, man, wow, that's a very impressive resume. And I would say this is one of the reasons why we like working with One America. I mean, of us being able to have access to you guys for this interview, at least reminds me of how much you guys care about your advisors. So we thank you for your time.
Our pleasure. Absolutely.
Now, one of the things that we want to talk about today is we've got a list of questions that we're going to cover here, but let's just dive right in. I'd love to, if you guys could maybe kind of jointly hit on this, but one of the questions that we get often is, what are dividends? Right? What are they?
Mm-hmm.
How are they calculated? And if you guys could give us some insight on that, that'd be great.
Great question, because dividend is used in multiple different contexts. For whole life insurance, in a way, you'd say dividends are really a return of excess premiums over time. And let me explain what I mean by that. For whole life contracts, the values that accumulate on the base policy at guaranteed rates of interest and mortality, and typically the premiums are set using more conservative assumptions than the guarantees. And so based on that, obviously the experience is expected to be favorable over time, and as it does emerge in that context, that experience is passed back to policyholders in the form of the dividends. And the amount of that is determined every year based on the investment performance and the mortality, and is declared by the board of directors by the company. So a fairly robust process that goes through that, and it's been a long-standing, established actuarial process and highly rigorous that goes into it. So that's why I think it stood up so well over the test of time. And one thing we do like to point out that dividends on a whole life policy are not like dividends on a stock, but they are a part of the inherent design of the contract to give its long-term stability and let it do the things it does for people in the marketplace and for you and your clients.
Now, let me jump in there. One word that kind of came up a couple times already was actuary. If you guys could give us a list of a working definition of what that word means.
Of an actuary? Well, there's probably lots of definitions. Number one, an actuary is a defined profession. There's a rigorous set of exams to go through, professional code of ethics, just like a CPA or a doctor or a lawyer. An actuary is a profession. So it is something that you have to qualify to become, and also keep your continuing education, all those things there. So at the base, it is a profession. What they do is, I would say, basically, we design financial systems that are built to last, would be my simple way of putting it. And in doing so, using statistics and financial math to make sure that we're putting together products and solutions that is primarily in the insurance realm, where you can take the uncertainty that clients have and pool it into a risk pool that helps stabilize that for clients and manage it over time, so we can deliver on the claims and experience over time.
I will say this: it makes it difficult for our spouses to explain to people what we do. But one of the ways, another way to think about what Dennis said is, and I guess the short version that you can use is that we calculate the financial impact of future contingent events. So a lot of future contingent events like interest rate movements, mortality rates, disability rates, long-term care events. Actuaries are trained to quantify the impact of those future risks into today's dollars. And to Dennis's point, do it in a way that you can build financial systems that are built to last.
Great, gentlemen. Thank you for sharing that. I'm glad because, and I hope you can correct me if I'm wrong, if this is a poor analogy, but often when we're talking about policy design and dividends and those things, is that the client's word actuary will come up, and I'll say that actuaries are the ones that design the product, the engineers of this, and I'll liken it to kind of a bridge, right? As you guys are designing these products for stress, right? And so when someone's building a bridge, forgive me for weight measurements, but maybe they're trying to build a bridge that will make sure they satisfy 20 tons of weight to be able to pass over that bridge. They're not going to design it for 20 tons. They're designing it for, 40 or 45 just to make sure that this thing is successful and that it works.
Absolutely. I actually have a whole analogy I could share on that, but the short of it is you have to build insurance products the same way you build a bridge, such that it can't fail. Because if bridges could fail, commerce would halt in America. So I could give you a longer version of it, but bridges are built to last 30 years, past their useful lifespan, and make sure they're still going to stand up if there's an ice storm with 100 loaded trucks stranded on it at that time. So we have to think of the same way for insurance products. That's something that we take pretty seriously at One America. And to be fair, I think most mutual companies build their products in a similar fashion.
Great. Now, Cameron, I'll tell you, if Dennis or Steve don't correct you when you're wrong, it would be my pleasure. Okay. In regards to dividends, when the board of directors declares, so are they declaring a dollar amount, correct, or a percentage amount?
Well, typically the actuaries will go through and create a recommendation that is presented to the board, and it comes in the form of a dollar amount. So we'll calculate the, using, as Dennis indicated, longstanding actuarial principles, typically referred to as the contribution principle, where you determine divisible surplus and it's allocated to participating policyholders in proportion to how they contributed to that. The actuaries will go through that calculation and make a recommendation to the board for the total dollar amount to be distributed. And that's what the board will review and approve, is the dollar amount recommendation.
And that's an aggregate number for all participating policies, typically.
When that is reported, so here's kind of some of the confusion is that, thanks for kind of clarifying that, is there's a dollar amount that's reported. A lot of times I hear about dividends when clients are trying to compare declared dividend rates amongst companies. You guys, if you give some insight on why it's a very difficult to compare, or if we should or if we shouldn't be comparing those rates?
Great question.
Sure. I think my first response would be you should not be comparing those rates. And I can elaborate that a little bit. And we report our total dividends in our statutory statements. We don't necessarily do all the public reporting that some other companies do in Wall Street Journal and such, but that information is available. We do not actually publish a dividend interest rate at One America because we just don't feel that it is a comparable value. It's more likely to be misused than it is to be useful. And so, because it's just one of a number of variables that go into the determination of a dividend, and each company would do that slightly differently based on how they've got their established practice or it's evolved over time. So, not that any one is right or wrong. And over time, you'll see that the movements in the dividend interest rate will tend to be very consistent period to period, because virtually all companies are operating the same market, buying the same types of bonds in the long run. So while it gets compared, on the absolute level, it's not directly related to the rate of return the client will get on the cash value, strictly speaking, because there's other factors that are in there that have to be considered. But over time, I think you'll see the movements in those will tend to be very consistent company to company.
Great, Cameron. I like that you asked that question, and I really appreciate the answer. What I've seen in my practice is I will get some clients, and they may be talking to some of the other maybe well-known branded insurance companies who are touting their dividend rate. But the way that we're working on our clients, really, they're focused on cash value. And at the end of the day, we want to make sure that that cash value is going to be there. And when I've even ran a competitive situation with a higher company, at least they were claiming that they had a higher dividend rate. When we ran the calculation with One America had more cash value and more death benefit for the same premium. So there's a lot more going on than just the dividend rates. What I found is most companies, they're going to tout whatever benchmark they have a higher number at. But again, just so we talk with our clients, it's not about rate, it's about velocity and the volume of dollars. At the end of the day, I want to make sure that I have cash value and that cash value is going to be there when I need it. Any other questions on dividends?
Well, I do think, it's a very important point that you made there. And to follow up on what Dennis said, you have a dividend formula. When you go to calculate that for any individual policy, there are several variables that go into that dividend calculation. The dividend interest rate is only one of those variables. It's an important one, but it's not the only one. And I think to the point you just made, when you just look at the dividend interest rate and ignore the other variables, you're not getting the total picture of what the dividend calculation is. So while it is very important, it's not a complete story.
It's probably worth inserting here too. You talked about this a little bit, Anthony. When you're comparing illustrations, both of those are non-guaranteed. But what that does help you see is that you can see the impact of a higher dividend interest rate may or may not result in a higher illustration. Recognizing that, again, none of those things are guaranteed, and I think part of the equation here is how do companies perform over time against that. And I think the higher you set or try to push your dividends today, at least in the pressure we're under, the greater possibility that you won't be able to deliver on that in the future. So part of this is trying to be balanced in how you're doing that and sharing with clients kind of where you're at. So all these things are subject to change over time, and in the long run, I think, again, it's important to remind ourselves that all companies are in the same environment. And so a big part of how you want to be choosing your company, make sure we have a long-term perspective, and also how we're partnering with you and your clients and delivering on those things is equally important. It's not all about the illustrated values, although I get it, that's important as well.
Exactly. Yeah, and Cameron had mentioned on our last podcast is that really the way that we're teaching our clients to use their policies, the real value is going to be is how they use it, not so much how the insurance company is performing. And oftentimes too many people are focusing on a name brand or a dividend, when really what we teach people, we want to focus on a mutual company that's been around for 100 years or more and has paid a dividend every one of those 100 years.
I was going to jump in here real quick, and just because we're touching on dividends and then also illustrations, is one thing that I always try my best to share with clients. When we are looking at an illustration, that dividend is non-guaranteed up until the point in which it is paid, and then it gets moved over to the guarantee column. Is there anything you can maybe add or kind of share on that piece of it right there?
No, I think you said it directly. Once the dividend is paid, the most common option that we have in our policies is paid into a paid-up addition. And once it's paid in there, it becomes a guaranteed value and can accrue future dividends as well. So it can compound on that. And the only way that doesn't, if you stop paying premiums, of course, you can use those values to pay your premiums over time. So that's the only way that those become, your value would go down at that point if you use them to offset your premiums. But once the dividend is paid, it's in the contract and it's like you gave us the money.
You had mentioned PUAs or paid up additions. Could you maybe explain how does, on the insurance company side, how do you guys define and look at paid up additions?
Yeah, so I talked about it there in the context of the dividend option where you have it go into the dividend. So as a dividend, it goes back into the policy, buys some additional death benefit, and keeps growing inside the policy. The other option that is a possibility is we have a paid up additions rider that you can add on to the policy. And that allows clients to have some flexibility to pay additional premiums or potentially to reduce premiums each year because it's an optional premium rider. And so the way that works is if you have that premium and you put it in the policy, it buys what we call paid up additions, so you get a single premium that buys a death benefit that's guaranteed. And then going forward, that can also earn dividends. Paid up additions typically have a slightly different dividend formula because it's a single premium versus a pay over time, but it follows the same principles in that context. And there are limits typically on paid up additions, both from a company risk perspective and investment perspective, as well as I think for you guys, it's also important that there's a limit to how much you can put in to prevent the policy from becoming a MEC.
Explanation is one question that we've got kind of as I think all of this is affecting all insurance companies right now is we've got new CSO tables, right? If you could take a minute, could you kind of maybe give our audience a definition on how CSO tables are used, and then also how the impact of this updated CSO table that's coming out and companies are implementing may impact policies moving forward?
Yeah, so with the 17 CSO tables, it's the most recent NAIC approved mortality table. If you go back through time, insurance products have had to be updated on for mortality tables. There was a 48 CSO, an 80 CSO. I think there was a 58 CSO in between there. Then we got the 2001 CSO and 2017 CSO. So what this is representing is reflecting ongoing mortality improvement in the required mortality tables that companies have to use for certain calculations. So I think one of the confusing parts is that people think that this is changing what pricing mortality expectations are, when in fact, what the CSO tables do is dictate the mortality rates that you have to use for reserve and cash value calculations. You're still, for your premium development, going to use your best estimate mortality expectations. So, there is a little bit of misunderstanding about what those tables are used for. So first and foremost, they are used for policy values like reserves and cash values. What we've seen in 17 CSO mortality tables is the reflection of ongoing mortality improvement. Mortality has gotten better since the 2001 table, so that is lowering the amount of mortality that you have to put into your reserve and cash value calculations. So with this new table and with lower mortality rates, the impact of that varies quite a bit across different insurance products. By and large, the lower guaranteed mortality means you have lower reserve requirements. But the impact of that is not nearly as significant as some other things that are going on in the environment. At the same time that we're moving to the 17 CSO table, you also have this, recognition of the sustained low interest rate environment, as well as new reserve rules called principles-based reserves. So you have all of this going on at the same time: 17 CSO, principles-based reserves, sustained low interest rates. So with new products that are coming out, all of that is kind of baked into the new product. And I think I think some people have mistakenly assumed that everything that's going on with product development is 17 CSO, when that's just one variable of many going into new products today.
Interesting. Would you mind defining for our listeners and Cameron what COS stands for?
CSO tables are, the CSO is Commissioner's Standard Ordinary. So, so because it's commissioners, that means the NAIC approves it. The National Association of Insurance Commissioners have to approve the table, so that makes it go into effect in all of the different states. So that's the C part. And then Standard Ordinary is for standardly underwritten ordinary life business. So there are other offshoots of these tables that are used for other products. But for the bulk of standard ordinary insurance products, this is the new commissioner-approved mortality table. So that's what 17 CSO is a mouthful, but it is the Commissioner Standard Ordinary table. Does that help?
Yes, perfect. You got it, Cameron?
It's mostly a historical, legacy type references. As you can see, it's been there since 1940. Steve's much older than me, by the way. That's how he remembers all that stuff.
Well, my dad actually sold insurance under the 41 CSO table back in the day.
It's the same over here. Anthony is much older than myself.
But, like a little side note, we just had an open house to celebrate our new office. And there was one guy who came in. I didn't even tell you this yet, Cameron. And he didn't know our names, but the way he described us to my wife was, I want to meet the guy with the good hair, and the guy with the glasses. I'm the guy with the glasses. Bad, but Cameron's hair does look nice. But you had mentioned the low interest rate environment. Would you guys mind taking some time and explaining what you guys invest in, and also what the impact of this low interest rate environment is going to have on the company?
Right. So for whole life policies in particular, and it's probably true for most of what we buy, but for whole life for certain, we tend to buy almost exclusively high quality long-term corporate bonds. So we're generally buying the long end of the yield curve, and we're typically buying out 30 years or more. So typically in a whole life portfolio, and we're not, all companies will be very similar this way. You have bonds that we've purchased over the past 30 years comprising our current portfolio, and that results in our portfolio rate, which is what companies use to determine their dividend scale. So that tends to move slowly over time. As you buy a bond 30 years ago, you might have earned 8% on that bond, and you buy a bond today, you're hoping to earn 3.5%. So in aggregate, you've got a portfolio that yields somewhere in between those two. How about I'll leave it there. And so you're buying those 30-year bonds over time, and as rates have come down somewhat secularly and continuously, all money that we bring in today and will roll over from maturing bonds in our portfolio will get invested at today's rates. The net result is you've had a downward pressure on the portfolio yields, and if you look at most companies' dividend scales, you've seen that come through in a fairly consistent fashion across the spectrum of whole life carriers. And certainly in the past 3 to 6 months, even we've gotten to even historical levels in the long end of the curve. And it's probably worth clarifying here, the interest rates going up and down, and the Fed doing certain things. That doesn't affect what we do very much at all. because the Fed only controls the short end of the curve. We're only and buying on the long end of the curve. So we've seen that come under more pressure recently in that context. So there's, in the current environment, generally speaking, the yields that companies will be buying their bonds at today will continue to be below their portfolio yield that they have on the book. So there's continued downward pressure virtually across the board on the whole life side. And actually on UL and IUL too, all those carriers are basically holding the same kind of bonds with downward pressure on yields across the board. The one thing on whole life that you have, of course, is the guarantees on the whole life side that you can rely on in that context.
And I think an important follow-up to that is, One America's philosophy on how we back our whole life portfolio is to buy high credit quality types of bonds and mortgages. We do not go down into the riskier end of the bond market to any large degree. Certainly that's tempting for a lot of companies to do that as a way to try to get extra yield. For us, our belief is that that's not the prudent course to take for our policyholders. That's putting too much at risk. And when things happen like the financial crisis in 2008, 2009, that ends up with a very bad result for policyholders. We were the only company, we had the lowest losses of any insurance carrier during the financial crisis because of our focus on high quality. To the point that was made earlier, we're in this to last, build to last. And our philosophy is that the way to do that is to make sure we stay in the high end of the credit quality and make sure that it can be there when customers need us most.
I remember when I first started doing business with you guys, this was in 2009. Maybe I went to a meeting in 2010, but in this year, this was right after the financial crisis, and insurance companies and even the U.S. government ratings were actually going down. But I believe that One America actually got an increase in their bond rating.
Yeah, we actually were, at that time we had a Moody's rating, I believe, and we discontinued that just because we didn't think it was worth spending the money to get it. But their last rating action for us was to increase our financial strength rating right in the midst of the financial crisis. So that's a true statement, Anthony.
So if interest rates stayed this low, you'd mentioned buying 30-year bonds. Now, right now, we have the ability, since some of these bonds that are maturing or you bought it at 8%, if we stay in this low interest rate environment, say 20 years from now, then you will have had 30 years of these low investment rates. Is that, if that were to happen, how's that going to impact life insurance companies?
I think that over time, 30 years at 2% long-term rates would your portfolio eventually has to all turn over. So I think there's a couple of things would happen. Number one, most carriers have, surplus and things like that. They're designed to withstand some of those things, but some of that's a fairly extreme scenario. I think you would also see in that environment, you would have to decide whether you want to take a little more risk in certain places to reach that. Because one of the things that we have as a floor is for tax code purposes. We have to have a minimum 4% floor on our cash values to qualify for the tax treatment. So two things. One, the in-force will create some pressure, but you'll also see for new products, we can continue to price and increase premiums to offset that. So two things will happen. The price will go up and companies will continue to generate business that is profitable on the new business. At the same time, we'll cope with the compression of our in-force block, which, candidly, we've been, as most carriers, and we're not unique this way, have had spread compression. We wrote products in the 80s and 90s that had 5 and 6% guarantees that we continue to support and pay and carry forward. So part of this is you'll see new business adjust to help offset that, and we'll also do all we can on the investment side to keep that going and manage our expenses as well. Of course, we have had favorable mortality profits on this business to help offset. So certainly that environment will be one of that we all wouldn't choose to take, but I think that's part of building these things and manage them over time. So that's not the environment I hope for, but I think those are the environments that we do try to take into consideration as we're managing going forward, to make sure we can manage through that.
What we tell our clients and our listeners, we cannot manage, we have no control over interest rates.
Yeah.
Interest rates are going to go down, interest rates are going to go up. We don't have any control over that. So what we do have control is how we use it. And that's really what, by having a sound foundation of a solid mutual company as your foundation, that you are going to be okay. And in the long run, things are going to go up and things are going to go down, but we need to make sure that we're working with a company that is going to be there when you need it.
Yeah, I think maybe this is a little not exactly on the question, but in the environment you describe, you're really talking about a situation where people are describing a return of their money is satisfactory as opposed to return on their money. So I think we live in a world still, especially in the United States, because we haven't had these negative yields, where as these environments emerge, the notion of what's a good return will be something that we'll have to adjust to and understand as well. Certainly. In those environments where you have a long-term yields that are low, would put pressure on whether you can even have a positive asset return. There's something like there's trillions of dollars out to 10 years in the curve or longer returning negative yields around the world right now. So,
but I do think it's important that in the scenario that you described of not just sustained low interest rates, but long-term sustained low interest rates, I think it's very difficult to predict what will happen with other parts of the economy, as well as what will happen regulatorily. Dennis mentioned the tax code. I think if we stay in the sustained low interest rate environment, it is going to force some changes in the tax code, and we're going to have to be active as an industry to make sure that we're engaged and involved in constructing something that continues to make sense for policyholders and still recognizes the incredible benefits that life insurance provides, and be able to maintain the tax benefit structure that it has while giving us a little bit of relief from the guaranteed rates we have to use.
In regards to dividends, can you explain the difference between direct recognition and non-direct recognition?
Yeah, so this is Dennis. I'll try to take that and Steve can chime in. So maybe the history first, I'll say 1980, give or take, a lot of insurance companies, I've always had policy loans, but most companies had what they call maximum loan rates of like 3%. So if you bought a whole life policy pre-1980, you could get a policy loan at a fixed loan rate of 3%. So obviously you guys will know the interest rate history in the early 80s. You could basically go to the bank and get a CD for 15%. And what you had happening was people would just take all their money from their insurance policy and go to the bank and have an arbitrage on that policy. So insurance companies obviously had to liquidate or sell lots of bonds at a loss at that time, and found that that put a lot of pressure on their model. So as a result, they developed two different options for policy loans, and these were actually developed and they're put into what they call model regulations. And most states have adopted these regulations in one form or another. And there's two options that they developed, both of which are designed to immunize the insurance company from that disintermediation risk of the low loan rate when short-term rates are high. And in the long run, we're neutral on which one is better or worse. They both will work just fine over the long run in a portfolio, but at any given time, they'll work a bit different. So those are direct recognition, and you call it non-direct recognition. The other name for that regime would be a market loan rate structure. And we are a market loan rate structure, which what that means is every policy in our portfolio will get the same dividend payable regardless of whether they have a policy loan outstanding or not. And so it's a non-direct recognition contract. If you have a policy loan, you're going to then pay what we call the market loan rate, which will fluctuate over time. If rates go up, you'll pay more. If rates go down, you'll pay less. And that is actually an asset on our books that goes into the dividend calculation. So that's a fairly rapid description of how that works. In a direct recognition contract, policies that have a policy loan will actually receive a different dividend than the remaining policyholders, and they'll have an adjustment to their dividend based on the amount of the loan outstanding, and also relative to the policy loan rate versus the current dividend yield. So, historically, at times that the loan rate will be lower than the dividend yield, which will result in a lower dividend. Currently, in many cases, the loan rate on direct recognition is actually higher, and could actually result in you pay a higher loan rate and you get a higher dividend. So, because it's a direct recognition. So, I guess there's advantages and disadvantages to each, and they'll work differently during different times depending on the relationship of the loan rate and the relative to each other. We use the market loan rate or non-direct recognition, and I guess the ease of that is everyone's getting the same dividend and everyone will pay the same loan rate, and it's sort of easier to understand and manage over time. Does that help? Any questions that come from that?
No, that was great. In regards, let's expand a little bit on policy loans. From the insurance side's point of view, how do you view policy loans? Is that a good thing or a bad thing or somewhere in the middle?
So I would say, again, the primary purpose of what we build and provide is the death benefit and the stability and the certainty that provides to an uncertain event. And that's an important part. So everything we do is focused on ultimately the death benefit and the advantages that creates, whether it's for, I'll say, the uncertainty of death, right, when you die too soon, or the certainty of death we're using for estate planning or legacy planning. That's ultimately how we do that. The cash value component, of course, is something that we have to provide, and actually it's a discipline that actually helps you stay away from pricing techniques that don't make sense. But as a result, we put loans as part of that. So I think loans are a valuable tool to use in the policy, and I'll say to some extent it's kind of all things in moderation, right? So it's a valuable tool you can use, but it can also result in the policy not persisting. If you were to take a loan out to a high level and something were to happen to your cash flow and you couldn't keep your policy in force, it can have some unintended consequences. So certainly it's a good feature of our policies, and it's used commonly to different degrees by different folks depending on their situation. So, but it is an all things in moderation kind of thing from my perspective. There are times it will make sense, and as long as people understand the implications and can manage it effectively, then clearly it's a valuable option for people.
Yes, I think the short answer is we're somewhere in the middle. It is something, to Dennis's point, it is a great feature to have and provides the policyholder a lot of flexibility. That ability to access cash for certain financial needs is a great benefit of a life insurance contract. But there is a risk that they get overused, either overloaned, which is a bad consequence, or overused, which tends to sort of tax the administrative capabilities. Insurance companies were not built to work like a bank, where you kind of have an on-demand cash option there, where you can get money in and out frequently. So from that aspect, we try to make sure that we have loan provisions that provide the flexibility and advantages that can really help the policyholder. But we also do try to keep an eye on it so it doesn't get misused and overused.
Great.
I might give you just an analogy on that I think will be helpful. It's not a bank, but it is. Insurance has two components, right? There's an insurance component and a savings component, and so this is really, I think, more like it's a savings account, not a checking account. So if you build up and save it over time, that's available for use. And of course, it's important to replenish that or maintain it to keep it robust. That's just true for no matter how you live your financial life. having savings is always going to be a good place to have it. So.
Yeah, I like that it's a savings account, not a checking account. And when we have our clients who we call them like a power user, somebody who's constantly maybe repaying and taking loans, I tell people, remember, who owns the insurance company? Like we do. It's owned by policyholders. We don't want to put an extra burden on them. And that's why when we do have a lot of activity, we recommend that they set up a separate account. And that's one that we could, have a lot of transactions going in and out of. And so you guys helped out in regards to the loan from like a policy owner's point of view. I'm curious what the insurance company's point of view is on having policy loans as part of their portfolio.
Well, there are pros and cons to it. There are a lot of positive attributes of having a policy loan as an asset for the company. It is a pretty well secured asset. And depending on what the loan provisions are like, it can provide a pretty good return for the company. On the flip side, I think it's also somewhat restrictive to us as a company because that is, we do like having the bonds and mortgages on the books. It gives us a lot of flexibility on other transactions that we can undertake to help provide additional value to policyholders, and policy loans are a little bit more restrictive for what we can do. So, it's back to Dennis's point, all things in moderation. We are not opposed to policy loans. They are not problematic in and of themselves, but we do try to keep a close eye on the amount of policy loan activity that we have and make sure that we're not getting ourselves in a position that we're too pinched in on what we can do with some of our other assets.
Another aspect that I would share is that, when you're building a whole life portfolio, we have, hundreds of thousands of policyholders in that portfolio, and they're all pooled together collectively. And we do that based on a set of assumptions. And that's based on, longstanding history and all those things. And when you have, subsets or cohorts of policies that have high policy loans, then when certain things happen, they could behave differently and they could affect other assumptions we make. So I think part of this is having a balance, because everything we do here is law of large numbers, and we're trying to create, risk management and risk pooling over time, both from a mortality perspective and an investment perspective. So the power of the whole life portfolio and the pooling of your risk, both again on the mortality side, but also over time on the investment side, of being part of what I call a high quality bond portfolio that we manage for a very low cost. I think it's important to take advantage of that, and we want to make sure that we're comfortable with all of our assumptions as they pertain to that. So it's just like the other aspect. We never look at one component in isolation. You have to look at how it affects the whole.
Great, thanks, guys. Kind of transition here is, can you guys give us a little more specifics? We've been speaking kind of generally, but can you tell us a little bit about One America specifically, and maybe some of those benchmarks that you guys are proud of, maybe financial stability or dividend history?
Yeah, we've hit on some of these earlier in our conversation, but we are really focused on maintaining financial strength. That is first and foremost the mission of the company, is to be able to deliver on promises when customers need us most. During 2008-2009 financial crisis, we had the lowest losses in the industry. Today, we are in the top 9% of all life insurance companies on financial strength measures. So by that, we look at companies that are rated AA- and better from S&P, and also A+ or better from AM Best. So out of 358 life insurance groups in the U.S., only 33 companies can make the claim that they have those ratings or better. And we're one of those 33. So we're really proud of the financial strength that we have there. Some of the benchmarks that we look at, while maintaining our financial strength, we've been able to triple our sales over the last 10 years. We've been able to have a 16% annual growth rate in our assets under administration over the last 5 years. We also use a blend of metrics when we look at our peer group that look at growth and profits and surplus. And we have the second best performance out of our peer group over the last 10 years when we look at an aggregation of some of those metrics. So, we've been able to find that magic powder of being able to grow in a tough environment while at the same time maintaining financial strength that's among the best in the industry. So it's something we're very proud of and continue to focus on and make sure that we maintain that going forward.
Could you tell our listeners when you guys were founded?
1877.
1877. So
it's 142 years of performance that we've been able to look at over time.
Okay, of those 142 years, how many years did you guys not pay dividends?
That's a tricky question because I don't think we can verify that we did all the historical years. Let me say it this way. I haven't been able to say that we didn't pay one in any year, so it's more of a technicality, I think, than anything else. Sorry to be too legalese in my answer, but we haven't been able to prove that we did every year. But we can't see one where we necessarily didn't either.
So you guys paid dividends during the Great Recession and during the Great Depression.
The Great Recession being in 2008, 2009.
Yes.
Yeah, for sure, that one.
I think you can look back through the crazy high interest rates of the 80s, dividends were paid. During sort of the tech bubble during the 90s, we continued to pay. When the tech bubble burst, we continued to pay. During the financial crisis of 08 and 09, we continued to pay. So throughout economic ups and downs over the last 50 years, we've had a proven track record of paying dividends every year.
Well, one of the reasons why we like One America is because, again, you're a mutual company. You guys have a long history of financial stability. You guys support the infinite banking concept. And in addition, you guys are very flexible with the paid up additions, which all of our clients use that rider. Would you mind sharing how flexible your PUAs are?
This is Dennis. I'll take a shot at that. I think I don't know how to say we are flexible. We have spent a fair amount of time trying to understand all the ways that you can in creating product structures that allow you to use the paid up additions. Whether you can use them to help build additional cash. We also have death benefit options that allow you to put more death benefit on and fund it with the PUAs underneath. We do have some catch-up provisions in that context. So, and you can pay monthly, annually. I think there's lots of different variations I can imagine. I don't know if I'm hitting on the ones that you're talking about or thinking about, Anthony, but that's something that we've spent time on, trying to create options. And part of that is in response to some of the competition in the marketplace on things like universal life historically have been felt to be more flexible than whole life. And there's all these kinds of comments. So we have spent time over the years developing options that allow our producers to market and our clients to enjoy the flexibility at least some flexibility.
Yeah, we've, we're a whole life company. We believe in whole life. And with that, we've tried to provide a product portfolio and a set of riders that gives our advisors and our clients a lot of flexibility on how they can construct a death benefit and premium that fits their needs. So, that ability to use PUAs, to be able to go up to 10 times in the first year, to be able to use 3 times in renewal years. If there are times in your renewal years where, especially for those that have volatile income, and entrepreneurs or other types of incomes that might vary year to year based on economic conditions, sometimes they can't pay their PUAs that year, but we do have catch-up provisions that allow you to sort of make it through a little bit of time, but still be able to utilize the flexibility that you signed up for. We do have some of our riders that allow you to blend 1-year term with PUAs to a specified amount and allow you to make that 1-year term disappear quicker if you want to pay PUAs. Alternatively, if you want to put your PUAs on top of that coverage, you can do that as well. So a lot of options, a lot of flexibility, and all of that to try to keep our whole life portfolio as leading edge as we can make it, and give, again, advisors and clients a lot of options on how to create a product solution that fits their needs.
Yeah, what I really like with your flexibility of the PUAs, as you'd mentioned, being able to put 10 times base in that first year, and in addition 3 times during renewal years, but also, and this is what I think is probably the most important, is that flexibility even during the year, because there's some companies that will allow you to lower or raise the PUAs, but only on your anniversary. With One America, it's very flexible where you could pay the base premium monthly, annually, or quarterly, but you can do the same with the PUAs, but they don't need to be on the same mode of payment as the base. Meaning you can make the base premium monthly, and then you can make a PUA if you have a windfall, or some people use their tax refund, or if they get a bonus. But we can build in flexibility, because when your income's going up and down, we can build it so there will be room inside your policy to accommodate windfalls. But then also the opposite happens is, what if you're used to paying in the same amount of money each month, and life happens and
right.
You can't pay the whole thing? Having the flexible PUAs gives you an additional option to make sure that you can still keep your policy in force.
Absolutely.
When we're talking about PUAs kind of build equity and cash value inside that policy. On loans, can you guys tell us AUL's approach on loan interest? Is that charged up front or in arrears? You guys could describe that.
Yeah, actually, our practice is to charge up front. So it's a 5% loan rate. So I think you pay 4.76% up front when you take the loan. So
okay, so you're kind of charging the interest rate up front, but then what happens if you start making your loan payments throughout the year?
Well, yeah. So, it's a 5% effective loan rate. So if you took out $1,000, we're going to take $47.60 and give you the net money back. If you start paying that earlier, we'll adjust the interest in our systems accordingly. So it's a 5% APR if you think of it in like mortgage terms. So, you always have to work, we get this question occasionally where someone wants to see how that accounting all works, and you got to show them the interest theory. But we charge it up front to make sure. The reason we do that is to make sure that at the end of the year the policy isn't overloaned, so it won't lapse. So the reason companies tend to charge up front is to avoid situations where the policy will overloan and potentially be at risk of lapsing based on the current cash value. But if they pay it through the year, then we'll credit back the interest accordingly to the timings of the payments received.
There's one thing you guys mentioned a minute ago, but you mentioned that you were a whole life company. Is that can you explain what that means, or maybe give us a little bit more? Does that mean you guys don't sell ULs, or what does that exactly mean?
Yeah, so I probably, a whole life company, that is today our, philosophically our belief in what the right permanent product solution is. So we don't currently sell UL in any way on new business. We have in the past sold UL, but we stopped selling universal life, I think, in 2016 or 17 officially, and it had been kind of tailing off for us. So, more because that market has shifted more to index universal life, which is a product that I won't necessarily say is a bad product, but certainly we have concerns over some of the practices and illustrations and understanding of the product and some of the configurations that are being put together in the marketplace. That's a whole different podcast, perhaps.
Well, yeah, we're taking some time and doing some additional research on IULs because they're trendy right now. But
Absolutely.
we have seen it even when I had my CPA firm. I never had somebody with a whole life policy say, you know what, I'm 80 years old and my policy is going to lapse. It's never happened with whole life, but I've seen one time is too many. And I've seen it. Go ahead.
Well, yeah, it's very much a let the buyer beware, because whether you're buying IUL or UL, SGUL, or whole life, the company is buying the same assets to support that policy. All companies are buying long-term bonds and long-term mortgages to back their liabilities that they're creating on those products. So, certainly then you have to question how something like an IUL can so strongly outperform a whole life contract on an illustration when they're backed by the exact same assets. So, the clients need to understand how that's working, and the fact that what the company is doing is passing investment risk to the policyholder and giving them opportunities to do something different. But at the end of the day, it's the same assets supporting the policy, should create the same return to the policyholder, all other things being equal. So, it certainly gets into a lot of marketing and illustration gamesmanship out there. But, it can be the right product for policyholders that understand what they're doing and are willing to take the extra risk that comes along with it. But that extra risk does not come for free.
And the time it will take to manage the policy over time. So this is where, whole life, you pay your premium. I can tell you this, one of my favorite advisors over time, and he's passed away now, but he used to say, Dennis, I just sell whole life and fixed annuities. And he goes, you know why I do that? He goes, because every time when the market goes down, my clients call me and they go, what happened to my policy? I asked them one question. I said, did you pay your premium? And they say, yeah. He goes, your cash value went up. Real simple. Doesn't matter. It's not about anything else. If you do what you're going to do, the policy will do pretty much what it says it's going to do, and you can rely on it. So that's the power of the guarantees. And of course, if you want to diminish the guarantees, I have to induce you with something, and that will be some kind of upside. And so that's the gist of these UL value propositions, or IUL, is I can pass through that investment risk and give you a higher possible outcome, but also a much lower possible outcome, with the expected value kind of being about the same and a lot more risk for you, and actually need to manage and pay attention to your policy. So I always think of these things, there's lots of risk that you can take in life, and one of the things is doing what you say you're going to do is kind of mandated in a whole life contract, and that makes sure we'll do our part, you do your part, and the client's kind of running it alone. And there isn't, the rigor behind a whole life contract and the established actuarial practice on the contribution principle and all the stuff we talked about up front isn't as much there on the universal life side. And those are more typically the companies running those aren't there are certainly mutual companies that do, but most of them are not.
Great information, guys. Thanks so much for touching on that. That's a big piece, and like Anthony mentioned, is we're taking some time, we're doing our research on that, and we are going to devote an entire podcast just to that topic. And we are getting together a lot of different resources. So, maybe we'll bring you back for that one. That was great information. Thank you.
Sure.
Well, great, guys. I would tell you, when we first decided to do a podcast talking to an insurance company, I was like, man, this is not going to be an exciting podcast. But, okay.
But then you decided that if we talk to the actuaries, that'll make it exciting.
Jazz it up a little bit, absolutely.
Yeah, but there was some great information here, and I think it's important to know where you are putting your money. And there was some good information on how the company works, what's going to be the impact of the low interest rate environment and also policy loans. So there was some great information, and I think our listeners are going to provide a lot of value and learn one of the reasons why One America is one of the companies that we work with.
Cool. Well, we really appreciate the opportunity, guys, and we do feel like we have a great story to tell, and we love partnering with really strong advisors like yourselves to deliver those to policyholders.
Well, great. Well, and also again, you guys are executives, high up executives in a very large insurance company. And for you, again, we thank you guys for taking the time out of your busy day to kind of share with us and kind of share with our listeners about life insurance. So thank you guys.
Absolutely. Our pleasure. Thank you, guys.
Thanks for listening, and be sure to subscribe so you don't miss out on the next episode. Also, check out our website, infinitewealthconsultants.com, to find our podcast along with other additional resources.
In regards to dividends, can you explain the difference between direct recognition and non-direct recognition?